Okay, so I guess that's everyone for today. So let's get started. All right. First and foremost, I want to thank you, every one of you who are here, for freeing out your time to join this sharing session by me and two of my friends later. So you could have choose this time to watch a drama, watch a movie, but you choose to be here. So I thank you for that. So secondly, this will be actually our very first Zoom sharing session on wealth and financial building topics. So my name is Joe, and I will be the main speaker for today. And later on, I will be inviting two of my other friends as a special guest for tonight to share some of their journeys in investment as well. So I really hope that this session will be beneficial to every one of you, whether you are a beginner, zero knowledge starter, or either someone who have traded a few trades in stocks like me. All right. So before I start, I just want to let you all know that this session, this presentation here is actually dedicated to people who have literally zero knowledge and background. So it's meant for people, those who are wanted to get into investment and want to know how to get started, okay? So because of that, I try to make things as simple, as digestible, and basic to understand as possible. I won't do much deep diving into how to research on a company background, to study on the fundamentals, things like that. So that will be meant for another Zoom sharing session. So today what I will show you is why you should start to invest, what exactly is investing, how should you have the mindset and the concept, how to manage your financials and where to get started, things like that, okay? So, right, I can see we have a mixed audience here. Some are beginners, some don't really have any backgrounds, so it's all right. Yeah, regardless of all, I hope that throughout this session you can take home one or two different perspectives and lessons or things that inspire you or impact you from today's session. Okay, let's get started. So first of all, disclaimer. So this presentation here is meant for sharing purpose and it's not any recommendation for you to buy or sell any of your stocks of investment. All right, always do your own due diligence and homework before you start any form of investing, and use the content in this slide at your own risk. Okay, so don't come and sue me or don't come and complain when you make some losses. Just kidding. All right, so at the end of this session, this will be the main objectives that you should be able to do. So first, you will understand why investing now is for everyone, but no longer for people who have financial backgrounds, people who are working in the Wall Streets or in the bank. All right, anyone here in this room are able to invest. So the other things you can learn is about interest rates and the different instruments of investment you can actually opt into to grow your wealth. So the other two things which I find it important for people who are wanting to start but don't know where to start is to how to manage your financials well, starting from your monthly take-home income and how much expenses you are spending out, and knowing how to start to take baby steps into investment based on what you manage your financials. All right. So yes, as I mentioned, at the end of this session, we will be having two special guests joining tonight, and they will be sharing some of their journeys and lessons they learned throughout trading and investment, and how they have come and reached their goals today, or they are still working on it. All right. So to start, I shall begin in part one, which is the introduction of today's session. So to make this presentation more interactive, I will be asking some questions and shooting some slides and QR code for you all, right? So here's the first question. Where are you actually keeping your money nowadays? So these are some popular options. First, most people will keep most of their savings in bank because it's meant to be the safest to store your money there, and it actually provides you some interest rate compared to storing in your biscuit tin or storing at your home or your safe box. All right. Some people might be more prone to invest in property. So people will try to save up a huge amount of money and they buy property, waiting for the property to grow in terms of wealth or capital gain, so they can sell the house in future to get some rewards from it. All right. So I'm putting these biscuit tins here is because for Asian people in the older generations, you can see that there are many people who like to store their cash in biscuit tins. So I read a couple of news articles that termites or fire, they actually destroy all this cash and you don't really have them anymore, correct? So I'm going to walk you through on the three different places that you are keeping your money. So first, if you're keeping your money in the bank, these are some pros and cons for you, all right? So first, we'll look at the interest rate. Bank is actually providing you a guaranteed interest rate, but it's a low interest rate. So for Singapore now, we can see it's around 0.05, and at the most it's around 2.5 or plus minus there. If you are putting your money in fixed deposit, let's say, it will be around 2% roughly, and fixed deposit actually lock up your money for a certain period of years. So you can imagine it as borrowing your money into the bank for a certain period of time, say 10 years, 20 years, and they're actually paying you interest of say 2% per annum of that. So when I say per annum here for beginners, per annum meaning this interest rate is what you will get throughout a year, all right? So highly likely the interest rate that banks quote you are highly dependent on the economic outlook, not only on a global perspective, but also on a country perspective. So something more relatable to us will be in this period of time, you can see that COVID's actually hit the global economy quite hard for the past few months. And right now, interest rates throughout the world are actually in a historical low, I would say. All right, so interest rate that the bank is willing to pay is actually quite dependent on the global and country economic outlook, I would say. But in terms of the pros, when you're storing your money in bank, you actually have a high liquidity. So what do I mean by liquidity here? Liquidity, you can imagine it or take it as how quickly you can withdraw your money or to cash out your money. So today, if you have 1,000 in the bank, you can easily go to the nearest ATM you have and cash out that $1,000. But if you are putting that $1,000 in the stock market, for example, or rather in real estate property, your money is not that liquid. You can't really cash out your money as quickly as you can from the bank. So that's one of the reasons I can think of why bank is still the most popular option for people to store their cash in the bank. And bank until today is still regarded as the safest way for wealth accumulation or saving your money in layman term. So the safest way to save your money, this is due to that banks are still mostly supported or governed by government institute or maybe regulated by government for say. So the interest rate they quote you most of the time are guaranteed and you have lesser risk to lose your capitals. So that's why people are putting money in the bank, all right? But as you can see, with the guarantee and the security they give you, they actually can only give you this much of interest rate for your money. So secondly, if you are putting money into real estate, say property investment, things like that, you need a large sum of one-time down payment to buy or to own the property. So the good thing here is that in the end of the day, you own that property. But first, you need one-time large amount of down payment to make that payment. After making that payment, you have actually a recurring fees to maintain from time to time. And as I mentioned, the money you throw into real estate can be very low in liquidity, meaning you can't really cash in your money, say in 1 or 2 days time. And price may or may not go up to the degree that you expected, all right? So the third will be keeping your money, your cash in your biscuit tin or your safe box in your home, for example. So people doing that, people try to store as much cash as they can with the cash in king mentality. But storing cash now is not very favorable because cash don't really give you any returns or any growth in your money. All right. So if you have cash, a lot of cash with you right now, I recommend you to store it in your bank at least, or to allocate some money into certain investment. All right. So cash has zero growth in money. So for example, if you store $100 in these biscuit tins 10 years ago, all right, and 10 years later today, you open up that biscuit tin, you have still that $100 you store 10 years ago. But the money now, the money that is worth now for $100 in 10 years ago, right now it might be way more higher. So you don't have any growth in your money, and it's 100% guaranteed that you have a capital depreciation. All right. So I will explain later why is that $100 10 years ago lesser than $100 10 years. Oh, sorry. The value of it actually decreases with that 10-year stretch, and why capital depreciation. All right. So after viewing these three options, if you actually have a chance to make money work more efficiently for you, since you are already working that hard in your full-time work, we will actually do that. And if you are doing that, will you still be putting your money in fixed deposits, or will you put it in the stocks market, property market, things like that? All right. So this is actually an open question, and there's no right or wrong question, right or wrong answer, I would say. This can be quite subjective, but right now, what I'm going to show you is a concept that I feel that all zero knowledge beginners should know before they make any form of investment. And this concept is called time value of money. So what is time value of money about? Time value of money, to put it in a simple way, $100 today is actually more than $100 in the future. And the factor here is time is money. All right. So with the example I showed you earlier, $100 that you put in your biscuit tin 10 years ago actually worth more than the $100 you take out from the biscuit tin today. Okay. So you'll be asking, why is that so? It's still $100, right? So this is some examples for you to walk you through. So today, if you put $1,000 in the bank can pay you 1% of interest, for say. So next year, you will have $1,010 in your bank account. In a layman term, in a year, your $1,000 actually helps you to grow $10 in a year, all right, with a 1% of return. So if you are buying apple today in supermarket, let's assume that one apple now costs $1, which is quite expensive. And your grandpa will tell you that 25 years ago, the price of apple was only 50 cents. And you can see that in 25 years time, the same 50 cents actually decrease in value, all right? So the 50 cents in 25 years ago, you can actually buy an apple, but you need 2 of that 50 cents, which is $1 today, to get that same apple. So this is something for you to think about, and people usually call this inflation. But inflation also means the power that you can purchase something, all right? So from another perspective here, you and your grandson. So today you are buying your apple for $1. 25 years later, your grandson will need $2 to buy the same apple, okay? So in this 25 years time, that $1 has grew in 100% of its value, all right? So the $1 you have today, 25 years later, is only worth, say, 50% of the value, okay? So time value of money is so important because it tells you that money today is worth more than tomorrow. And this is why people will want their money to grow in the long term, okay? So another question, 10 years ago, you keep $1,000 in your biscuit tin. So this is 10 years ago, I annotate here before, all right? So assuming that inflation was 3% for the past 10 years, today, the $1,000 you kept 10 years ago is already worth $1,343 now, okay? And the reason that $1,000 it grow into 1,343 after 10 years is because that inflation is keeping that money to grow. So as the $1,000 you have worth 1,343 today, the money you put 10 years ago, you take out is still $1,000. So in another way to say this, in 10 years time, by keeping your money in your biscuit tin, you actually lost $343 for this case. So why is $1 today worth more than tomorrow? As I mentioned just now, it can be due to inflation. So price tends to go up because of a lot of factors like company growth and they want to control the supply and demand, things like that. There are risks. Risks are involved in inflation is a risk, reinvesting is a risk. Time, there are also opportunity costs that takes into account of why money grows in time. So opportunity cost of investing today and if you're investing 10 years later will be different. So opportunity cost for personal growth as well. And all this is actually linked to time, all right? So this is why this very concept is called time value of money. So a quick chart here, we can see that $10,000 today has the highest value, but with the same amount of money, 5 years later, the value decreases and it's decreased again when we increase in the time frame. So to conclude time value of money, money is more valuable now in the present than later. And people would rather like to spend or rather have the money today than tomorrow. And the reason that time value money grows because of inflation is exactly why we should invest more, but not to keep our money in the bank. And if you keep your money in the bank in the long run, you are actually hurting yourself by having a less growth that lose the increase of inflation in price. Okay. So here's an example on how putting money in the bank can hurt you in the long run if you are not investing and how does investment beats you, okay? So today you're putting $1,000 again in the bank and the bank pay you 3%. So next year you have only $30 growth, all right? You say it's only 3%, what's the big deal? And the big deal is because every year this interest of 3% is added and this concept is called compound interest. In 24 years time, your money can actually double by every 3% of this top up interest rate. So in the year of 2044, in 24 years time, since you bank in your $1,000, this $1,000 is actually worth double in terms of the price. It's now $2,000. So as Albert Einstein quote, compound interest is the 8 wonders of the world. Those who knows it, earns it. Those who don't know, pays it. So why does compound interest actually matter, all right? Compound interest, like I mentioned, it actually adds up the interest on the money you earned previously from the previous interest you earned, all right? And compound interest is the main factor that causes or leads your account balance to grow and to double your money, etc., things like that. But compound interest can be a good thing for investment, and it also can be a bad thing as well if you are paying your interest rate for loans, all right? So it works well to grow your wealth. It also works well to destroy you by increasing the amount of interest you have for your debts. So compound interests are actually dominated by a few factors. So one will be frequency. How frequently are you compounding your interest? So if let's say I'm putting in a bank and the bank is giving me 1% of interest rate per annum, meaning to say you are actually, your frequency is 1 year and each year you are compounding your interest by 1%. So if I have an investment that can give me 1% of return every month, so your frequency of compounding in a year becomes 12 times. And this will actually give you a higher amount of your wealth, all right, in the long run. So time frame is important as well. 10 years of compounding and 30 years of compounding. As you increase your time frame, you can see the effect of compounding effects is exponentially growing. And interest rate affects as well for sure. 8% beats 5%. Deposits, how much money you are willing to put every month or every year into your investment or your loans or your banks. And most importantly, starting amount. Starting amount is very important as well, because whatever you are compounding is adding up to your starting balance and the deposit that you are topping up. Okay, so for those who are interested only, this is the formula that gives you the total amount you have at the end of the day with the compound interest formula, all right? So you have your principal. Principal is your beginning balance, and interest rate is basically how much percentage they give you. Number of times is compounded throughout a period of time frame, and this time usually is the total amount of years or total amount of months you allow your investment or your money to grow for. All right, for those who are interested, don't worry, I will be sending this PowerPoint later after the session, and you can refer back here and click on the link to play around with this compound rate interest formula later. So, all right, another quick example. You have a starting balance of 1,000 and you are saving $100 every month, which is your monthly deposit to say. And you do this for 10 consecutive years, and the interest is paying you, and the bank is paying you 1% of interest. So this is what you will get in the end of 10 years time. So you have an initial balance of 1,000 with every monthly top up of 100. In 10 years time, you are topping up 12 more thousands. So in total, your total deposit will be 13,000. All right. So with an effective annual rate of 1%, after 10 years, you'll be getting your interest rate of 727.18. This is the interest amount you earn if you put this amount of money into bank for 10 years. All right, I want you to remember this amount here, which is 727 from the bank with effective annual of 1% interest rate. So scenario 2, what if you have the same amount of money, but now you are not putting it into the bank? So I want you to imagine that you have a starting balance of 1,000 and you have invested this 1,000 into the stock market. And every month you are contributing $100 into the stock market again. And you do this every month for 10 consecutive years. So same starting balance, same money deposit, same amount of time frame, but the return now is 10% annually. So how do I get this 10% annually? It's based on the average market return from the US stock market. All right. So I'm sharing here a graph with you. This captures the S&P 500, Standard & Poor's 500 index from the US stock market. And this will be their historical annual return. So as you can see, the stock market is not a guaranteed return, all right? So there may be years that can give you easily up to 20% of returns, but there are also years that can give you as low as negative 30% return, all right? So why I'm quoting here average market return is because I'm looking at a more long-term perspective. So you don't get caught in a time frame where you have a deficit of 30% and you don't earn anything from the market, okay? So I want you to take note that any investing you are going to make, try to make sure that you are doing it in a long period of time, in a long-term perspective, but not in a short period of time. Because if you are timing the market, it can be very costly, all right? So 10% of interest, and we'll see the effect here is very different, all right? Same initial balance you put in, same monthly deposit, total deposit on 13K. But right now, after 10 years, with 10% average return per annum, you are actually earning 9,000 interest rate, 9.7K. So if you remember the amount earlier that we put our same amount of money in the bank, we are actually getting back 700 plus, all right? But now, if you are putting in the same amount into the stock market, in 10 years time, you are actually getting 9K more from what you are getting from the bank, okay? So this is something why I mentioned that everyone here should start investing and not to put all your money in the bank, because in the long run, it can hurt you. It can hurt you a lot, all right? So if you are still not convinced, here's a final example. So if, let's say today, I still have a starting balance of 1K, and I put $100 of money deposit in the bank. And this time I'm saving for long term, all right? I'm saving for my retirement. I'm doing this every month for 30 years. So how much are you going to beat inflation for, say, that bank is going to pay you 1% of interest per year? All right. So to answer this question, first we will need to know, one, what is the interest rate that you are trying to beat? Okay. So we can get this data from worlddata.info. All right. So those who are interested, you can log on to your Google or your Safari later to type in worlddata.info. They have tons of information about GDP, about inflation rates from different countries, and they are basically everything you need to know from different countries and how well is the country doing in a global perspective, all right? So based on the data I found from worlddata.info here, the interest rate for Singapore for the past 40 years, it actually fluctuates quite a bit. It's between negative 1.4 to 8.5. But as for the year of 2019, inflation rate was only 0.6%, okay? And some people may be very happy when they see interest rate of such low percentage, but when it's actually not very good to have a very low inflation rate for a country, as it hurts its economy, things like that. It's very complicated, but I won't go much into that details. So what I'm trying to find here is actually the average inflation rate for Singapore. And what we see here, the average interest rate is around 2.1%. So meaning to say, if I am to answer this question here, how do I lose to the interest, to the inflation, and how much money do I lose in the long run? So this is the amount I'm trying to beat. So let's see here. So before that, this is another graphical illustration to show you that how is the inflation rate in Singapore going. So you can see that it's quite high in the past, and it actually spikes up during 2020 and 8, and now it's moving very flat at around less than 2%. So I put them side by side. On the left will be your inflation rate that you need to beat, all right? And on your right, you have the money that you put in the bank. And I'm putting here 2% for the sake of easier to calculate, and 1% here for the bank. So 30 years down the road, you have put in 37K in the bank. And with 37K, you are earning back 6K of interest rate from the bank. But with effective annual rate of 2% of inflation, this is how much you are going to lose, okay? So if you are putting money in the long run in the bank, it can really hurt you quite a bit, all right? So the least interest rate that you need to aim for is to at least beat inflation, okay? So if you are putting money in the long run in the bank, you are not going to beat inflation like this. And in the long run, you will definitely face deficit, but not positive in this number, okay? So scenario 4, if you are not putting this money into the bank, but you are putting it in the stock market, how much will be inflation in this scenario? So on the top is the same amount, which is from inflation of 2%. And below here is the average market return. So as you can see, the amount is quite deafening. It's a large win All right. So there's no doubt that anyone that see this slide should know, don't put all your money in the bank. At least allocate some of your percentage of your monthly savings or your monthly surplus into investing, okay? Because in the long run, it can really generate you some profits, and it's better for you to build your wealth. So until now, you should be able to understand the concept of TVM, which is time value of money. You know that same amount of money today worth more than tomorrow. So you also understand this time value of money origins from the beauty of compound interest. So when your interest is added back to a principal and you top it up with some monthly deposits and multiply with the same amount of interest rate again, and you will be able to build your wealth exponentially in the long run because of compounding interest. So with these two concepts in your head already, how do you make your money work for you more efficiently? How do you actually grow your money with your money when you are working so hard to earn your money? So that will lead to my next topic. But before that, this is a rule that I want to show beginners. This is a general term of rule. So there's this thing called rule of 72. Rule of 72 is actually meant to give you a very simplistic way of calculating how much time do you need to compound your money to double your investment, okay? And the equation is simply like this. 72 divided by the rate of return you are getting will equal to the amount of time that you need to double your investment. So for example, if I'm having a return of 3% per annum, all right? So 72 divided by 3% here, you will need 24 years to double your investment. And this is exactly the amount that I put earlier on for the Apple. So if you remember the growth of the Apple, $1 today, and with 24 years or 25 years later, it grows to $2. And I'm basing that the rate of inflation here is close to 3%, all right? So this is actually a good thumb of rule for many beginners to know how much time you need to invest your money in, how much amount of money you need to put in your investment in order to hit your short-term, mid-term, or long-term goal, okay? And obviously, the higher the rate of return you are having, you will need lesser time to double your investment. So if you have 9% of return in average, so 72 divided by 9, that will be 8 years. So with 9% of rate of return every year, you just need 8 years to double your investment compared to more than 20 years or 30 years if you are putting that in your bank, okay? So this is an important concept and a rule that simple enough for everyone to remember, rule of 72.